Good day everyone, my name is Victor Schaefer and today I would like to talk about a topic your bank doesn't want you to know about. This is a mortgage option where you can pay off your mortgage 2 or 3 times faster without changing your life. You will literally save hundreds of thousands of dollars just because you're switching from traditional mortgage to this one. And this is the option that I use, my kids are using, whoever has a mortgage, and all my team members are using. And I always say, if that's something that the people who work in this industry are using, you don't need any additional advertising. Before I will do that, I would like to introduce myself. I would like to make sure that whoever is watching the video trusts me because, I can say whatever I want, but where's the guarantee that the guy has experience who is doing the presentation? I'm in this industry for over 20 years. I'm #1 mortgage broker for over 15 years in my province, and I'm in top 75 brokers across the entire country. The reason why I'm saying that, I just want to make sure that you believe me. But we will go straight in the presentation, and before we'll start the presentation, I still would like to do a small disclaimer. Finally, the entire presentation is prepared by myself, and I know this is 100% true, but I want you to make sure you do your own due diligence before you're making any financial decisions. What I would like to talk today about is about bank secrets, because there's so many secrets that the banks don't want you to know, and I will try to explain at least part of them during the presentation. I will show you what is the real cost of the mortgage, not what you think the mortgage costs you, but the real cost and how can you prevent that the bank takes advantage of you. I will talk about compound interest. That's a lot of people don't understand the power of compound interest. If it works against you, it's great if it works for you, but if it works against you, it costs you lots of money. I will talk about power of a prepayment. This is the best and the fastest way you can pay off your mortgage, and I will give you an option a lot different than what the bank would give you if you would ask them how to pay off your mortgage faster. I will talk about amortization period, and I will talk about interest rate. And I will also show you that amortization is a lot more important than the interest rate. The nature of my business is to get you the best interest rate. But there's many mortgage brokers who offer good rates. But with this option, you're not just getting a best interest rate, you're also paying off your mortgage 2 or 3 times faster by shortening your amortization. And at the end of the presentation, I like to show my clients, it's nice to pay off your mortgage. You feel differently, the air smells different, the grass you walk on is different if you don't have a mortgage. But if you watch my video and talk about Canadian pension system, you realize that's not really much income we should expect in our retirement. And it's nice within the next 25 years, if you pay off your mortgage 2 times faster, to maybe spend the remaining time and save on money. The first example what I would like to use, and I really sometimes I don't get it, how is it possible that people are treating a purchase of a vehicle a lot more accurate and properly than they're trying to get a mortgage, which is the highest expense you can have in your life, it's your mortgage. So if you go to a car dealer, you're not asking the car dealer, just give me an option based on price. If the car dealer tells you, I have 2 vehicles for you, one costs $10,000, second one $7,000, and no additional information. Would you jump on the $7,000 or you will ask additional questions? I guarantee you will ask additional questions. You will ask what kind of vehicle is that? What kind of a model? How many kilometers? You will ask if the vehicle has any accident. You'll ask a lot of questions. Why? Because price doesn't tell you anything. You want to know what is behind the price, what you're really getting. And this is the interesting part. If I get a phone call, not from my clients are really educated. But if I get clients from different banks or brokers and they're asking a question, the first question they ask, what's your best rate? I always tell the client, best rate, this is nature of my business. I will give you the best rate. But the question should not be what's the best rate, because the same like we just discussed the purchase of a car, the same should be with the interest rate. Okay, one bank offers me 5%, the other bank 5.25. I'm going with 5%. Why wouldn't you ask the question the same you ask a car dealer? What's behind this rate? What will happen if I sell my house? What will happen if I lose my job? What will happen if there's a death claim? What will happen if for whatever reason I want to pay the mortgage faster? So the #1 question I always tell my clients, you need to ask your bank or your broker, how much interest rate I will pay in the next 5 years. Not what is the interest rate, but how much I will pay. Then we're going already in the right direction. I do lots of live events across Canada. I like to be in front of people, but unfortunately because of COVID, there was lots of restrictions. but now I can travel again. I resumed my seminars across Canada. But I like to ask people in the room one question. If you get two options offered by your bank, one would be that 55% of your payment goes to the bank as an interest rate. And the second option, 30 years amortization with a 5% interest rate. That's approximately the interest rate what we have right now. It's actually above 5%, but let's just go with 5%. So I asked the audience which option they prefer. And majority of people jumping on the second option because they like 5%. They don't like to pay 55% to the bank. And then the proper answer is actually that this option, the first and the second, are exactly the same. It's just how I present this option to you. If I shock you to tell you 55% of your payment goes to the bank, and the second one, look, it's only 5%, about 30 years, that's a problem, the people are jumping in the second option. So then my goal in this presentation to show you how the math works in mortgages to understand that the number one priority should be short amortization and not interest rate. So if we're talking about what is affecting your bottom line, so what will be the final expense of your mortgage? So how much an interest rate you paid, not what was your interest rate. Nobody really should care about what is your interest rate. The question is, how much interest rate did I pay? Is based on what? There are some areas we cannot change. For example, we cannot change the mortgage amount. I mean, if you have 500,000 mortgage, it's a 500,000 mortgage. We cannot change really the interest rate. Even if you can, let's say you get crazy good rate, will be 0.1, 0.2, 0.3 maximum difference between different banks. We cannot change the compound interest. This is a big problem. I will discuss a little bit later. We cannot change the amortization if you go traditional way. With my model, that's exactly what you can change. You can change the amortization. And the last one, what you can control is the prepayment option. How much money do we really want to pay additional to pay off your mortgage faster? Problem is, people don't have money available for additional payments. If we talk to a client and we ask them that, I'm telling them, or one of my team members saying to the client, you have a 20% prepayment. All the clients are excited. Great, 20% prepayment. You literally can pay off your mortgage in 4.5 years if you use the prepayment option. Everybody is excited. Nobody does it. And that's the problem. That's why I like the option I will present to you, that you don't need to do anything. It will happen automatically. Everybody knows Albert Einstein. He said actually about compound interest. It's very interesting that this is the eighth wonder of the world. If you understand, then will you make money with it. And if you don't, you will pay for it. And to understand why the mortgages are so expensive, why 55% of your entire payment will go to the bank instead to pay off your principal, it's because of compound interest. And let's discuss what it is and how it works. Okay, compound interest means not really 2 plus 2, 4, it's plus 2 plus 2, 5. But let's go with the simple compound interest first. So I like to use easy numbers. If you borrow from someone $100 and this person says, no problem, you can have it, but I will charge you by end of the year 100% interest rate. Okay, again, just to do the math easier. So you borrow for 100, it's 100% interest rate, total interest rate 100% is $100. So that means by the end of your agreement, you need to pay to this person $200. Now let's go with compound interest. You borrow 100,000, the same. The interest rate that you agreed with is also 100%. So nothing is changing so far compared to the simple. But here now there's a difference. That the person who borrowed your money from, he tells you, look, I give you the $100, I will charge you 100%, but I want the first 50% of my interest rate 6 months later. And you say, no problem, I will give you $50 mid of the year. Now, 6 months later, the lender or whoever you borrow the money from come to you and say, okay, give me my first $50. And you tell them, I cannot, I don't have the money right now, but let's do it. By end of the 12 months, I will give you the full amount. Then I am, as the person who gave you the money, will say, no problem. I understand your problem. You know what I will do, the 50% interest rate now, or $50 interest rate, I will just put on top of your mortgage. Okay, great. And here is now the difference. With a simple interest rate, you will pay $100 to the final amount. Here, you now have $150, and the interest rate is now based on $150 for the next 6 months. So this additional $75. So that means in the first situation, it did cost you $200. In the second situation, it cost you $225. It's actually $25 more than the previous one. Why? Because you were not able to pay the full amount by end of the year. And this is exactly what the banks do with you if you get a mortgage. The compound interest with the bank is every 6 months. That means, really, if you have a 3% mortgage rate and you pay off your mortgage by end of the year or during the year, yes, you will pay exactly 3%. But you're not able to. And you're doing it for 25 or 30 years, right? Based on the amortization you choose. So that means they will do compound interest, interest on top of interest every 6 months for 25 or 30 years. Can you imagine the number that comes out? And this is the area what is very important for me to, that the people who watch this video understand that compound interest really, really works against you if we're talking about mortgages. So I would like to show you an example of, like always, numbers. Numbers work the best. Now I can say a lot, but if I show you the numbers, a lot easier. So let's say you have a $500,000 mortgage. Your interest rate is 5.5%. That's approximately the percentage which is right now in the market. Compounding period every 6 months. 30 years amortization. This is a traditional mortgage you get from any banks, RBC, TD, Scotia, Credit Union. That's how it works, okay? They give you a rate, every 6 months there's compounding interest, and let's say you choose 30 or 25 years amortization. So you will pay this particular person, if nothing is changing with the entire 35 years, or 30 years, the person will pay $515,000 on interest rate. So the total amount that he has to give back to the bank, understandable, $500,000 you borrow, you have to give it back, but you also have to pay additional interest rate. That means it did cost you over $1 million interest rate in principal. Those are crazy numbers that people need to understand. And the number one goal for you is how to pay as less as possible interest rate. That's what I said in the beginning. Not what's the best interest rate. How can I save an interest rate? And that's what we will discuss. I just would like to show you an option here. It's a $500,000 mortgage. It's 5.5% interest rate. If you pay this mortgage in 30 years, that's how much you will pay to the bank, $515,000. If you manage somehow pay 5 years faster, in 25 years, you pay $100,000 less. Do you know if you get a rate of 0.3 or 0.4 better rate than let's say whatever is in the market, it may save you in a year $2,000, $3,000. So here I can show you if you pay off your mortgage 5 years faster instead of 30, 25 years, it saves you $100,000. Let's go to the next level. If you pay it in 20 years, it's $321. That's how much you will pay to the bank. If you manage to do it in 15 years, it's $232,000. If you manage to do it in 10 years, it's $149,000. So the total difference from traditional mortgage that everybody has and everybody does, you would pay $515 because nobody really does prepayment. But if you pay off your mortgage faster, and some of my clients are paying out actually in 5-6 years, but we're shooting usually for 10 years. So it would save this particular person $367,000. Believe me, there's no interest rate on this earth which would give you so much savings, how much you save if you pay off your mortgage faster. And this is the nature of this product. This is the nature of the product all-in-one. And not just all-in-one, it's my personal one, which I call VS all-in-one, which we customize a lot better than what the bank's actually offering. So now we discussed this, right? We said that if you ask someone, if you call the bank or you call us, the first question you ask is about rate. You should not ask, what is the rate? You should ask, where can I save the majority of the funds? Okay. So let's go another example. I would like to show you now power of short amortization compared to a better interest rate. And I'm going extremely crazy with the interest rate because if you're in the market for a mortgage, usually the difference between variable rate mortgage or fixed rate mortgage, if we're talking about interest rate, it's usually 0.2, 0.3, if you're lucky, 0.4, but then you have really a mortgage with bad problems, okay, major problems. That means you should, like a car dealer, ask why this rate is so cheap. So, but I'm on purpose using extreme example here. The person has $500,000 mortgage, 4% interest rate, 30 years amortization. He would pay $355,000, an interest rate in this case, $748 in total, okay? Now the second example, the same $500,000, but the interest rate is 1% higher, not a little bit more, not 0.1, 0.2, 0.3. I'm talking about 1% difference. 20 years amortization. That means in this particular case, it's 4% in 30 years. In this case, it's 5%, but we paid it off in 20 years. So we paid off the mortgage 10 years faster, for whatever reason, we'll discuss this later. So the difference in the payment and the total payment interest rate, $355, And with the mortgage where you have higher interest rate, 1% higher interest rate, you pay 288. So you pay actually a lot less with the higher interest rate compared to 1% lower interest rate, but you're using the full amortization. So my goal is so far, and I hope you're not getting interrupted by your cell phone or anything else, because you will not get it. You need to stay focused on this one. I'm really passionate about this program because I like it. I use it. My kids are using it. My employees are using it. So you see the difference. So short amortization is a lot more powerful than the interest rate. And I went here crazy with 5% compared to 4%. So the difference with the higher rate, $67,000 that you could save if you shorten your amortization. Now, we already mentioned that compound interest works against you, right? This is important to remember. If you pay off something within a year, there's no compound interest. Or if you have home equity line of credit or credit cards, there's no compounding on this one, okay? There's just simple interest rate. But in the mortgages, every 6 months, they do interest rate on top of interest rate for 30 years or 25 years. And second thing, what I hope I convinced you that amortization is more important than interest rate. Okay, let's go now to the next level. I would like to show you a mortgage. Somebody got a mortgage from January 2023, and I would like to show you the difference in his payments on interest rate and principal. That should motivate you to pay as much as possible principal, because especially now with the high interest rate environment, it's gonna cost you a lot of money. Okay, so here is January 1st. The person pays $2,000, 61 interest rate, and $606 on principal. Months later, $2,059, principal 608. Months later in March, $2,056, 611 principal. So you see how slowly the portion of interest rate is reducing and how slowly the portion of principal goes up. So you pay a lot of interest rate in the beginning of your mortgage, and you pay really just a little bit on the principal. And many clients are using variable rate with a fixed rate option, which is crazy bad for you. It's good for the bank. But this is a different video, different topic. Maybe I don't want to talk about this right now. So for you, with today's rate environment, to be able to get your interest rate and principal in the same position, okay? Because you start with a high interest rate, low principal. Principal is what you pay as a mortgage, and interest rate is what the banks get, right? So to get to the point that principal interest rate is exactly the same, will happen in this case in 2039 in July. So you need 16 years. Literally, you need 16 years to be able to get your principal interest rate to the same amount. Okay, so you need 192 months. This is, if that's not shocking you, I don't know what can shock you. Okay, so now I would like to explain you how the bank make money. Okay, and why you should go a little bit deeper than just ask for rates. If you have a friend and the friend is asking you for $10,000 and you're willing to give him, right? You give him the $10,000 and he promised you to give it back to you within a year. Now, 6 months later, you need the money again for whatever reason. You call your friend and said, look, I gave you the money, but I have a problem. I need my money back. And your friend said, absolutely no problem. I will give you your money, but I'm going to charge you 6% interest rate. What would you say to this guy? I don't think he will be your friend for a long time, right? Because you gave him for free and he is charging you interest rate. Do you know that the banks do exactly the same with you? So you're working hard, very hard for your money. Your money for your paycheck goes in your checking account, and guess what the money is doing in your checking account? Absolutely nothing. Your checking account interest rate, what the bank will pay you, is 0.001%. If you're a little bit higher end client and you have lots of money, maybe they will pay you 0.1%. It's pretty much nothing. Now inflation is 7%, and you have 0% on your checking account. You know what your money does? Your money works for minus 7% because of inflation. So, and if you need money from the bank, they will come back to you and say, absolutely, if you need money for a car or a mortgage, we'll give you the money, but they're charging you interest rate. So we're giving them the money for free to work with, but if we need money, they're charging us. So why would we accept that? The reason why we accept that, because everybody does it. And I always say, just because everybody does it doesn't mean it's correct. Do you really want to be like everyone? Everyone means, I don't want to, offend anyone, but everyone, if you want to be like everyone, that means you have health issues, you have weight issues, you have family issues, you have this and that and that. So maybe sometimes it makes sense not to be normal, right? And today I'm talking about not to be normal in the banking industry, in the mortgage industry. Approximately $1.2 trillion are sitting on the bank's our 5 big banks account every day. So RBC, TD, Scotia, Bank of Montreal, about $1.2 trillion. Can you imagine how much money they get from us for free? Yeah, we could definitely move it from checking account to saving account. And how much do you save? Right now, the interest rate is a little bit higher. Maybe you get 2-3% if you're lucky. But still, they're charging you a lot more for your car loan, the credit card, or the mortgages. So, and I just want to give you an example. I just took a screenshot from a bank, one of the banks, how much they pay interest rate based on your balance. So if you have 1 million on your checking account, they will pay you 0.1. Okay, but if you have less, then you're definitely getting less. And if you have, $10,000 on your checking account, they will pay you 0.005. So pretty much nothing. Thanks to inflation, you can assume that your money is sitting right now on your bank account, wherever your bank is, for -7%. So what's the number one goal for us? How to shorten the amortization, how to pay off your mortgage as fast as possible, to have those compound interests which are accumulating every 6 months as less as possible, because you have them every 6 months for 25 or 30 years. Okay? So to explain this, I always like to use a ladder, because if you look at this guy who's going up the ladder, there's stairs, right? And I always like to say one stair, it's one principal payment. Let's say the horizontal is principal and the vertical is interest rate. So every month you go one step, right? You pay interest rate, you pay principal. You pay interest rate, you pay principal. But how is it possible? What can we do to skip those steps? Because whenever you skip one step, you still have to pay principal, but you don't pay interest rate. So let's just assume that that's our goal, that we can skip those steps somehow, and I will explain you in my next screens or slides how this works and how can we make really sure that we're saving an interest rate. Okay, here is an example of a mortgage where a person does just $10,000 prepayment. Okay, he got a mortgage, brand new mortgage, $500,000. It's always $500,000. I use $500,000. Interest rate is 5%. Your payments are $2,061 interest rate in the first month and $606 principal in the first month. Next month, it's $2,059 and so on. So you see that you pay a lot of interest rate. Now let's say from whatever, we're just ignoring the point where you get the money from. But you got the money somewhere, $10,000, and now you're prepaying your mortgage. Okay, what you do, you're actually putting it as an additional payment. You know what's happening? You're skipping all those steps for 16 months. So that means if you do $10,000 prepayment, you skip 16 steps. You jump. Maybe you can jump. So I don't know. But anyways, that's the power of prepayment. If you saved, look at this particular case, it's 10,009 because I played with calculator. It's not so easy to get exact 10,000. But let's say that the person put in $10,009. He saved an interest rate. Look at the numbers. He paid 10. He saved $32,000. By investing $10,000 in his mortgage, specifically in the beginning of your mortgage, he invested 10, but he saved 32. Why? Because he jumped all those steps, he skipped all those steps, and he saved this side on the interest rate. He still has to pay the principal. That's what the 10,000 are divided by. But the interest rate we're saving. And this is huge. This is powerful. If you understand this, you will understand why actually this all-in-one product works so well. If you go to your bank, the first thing what the bank will tell you if you ask the banker, you know what, I would like to pay off my mortgage faster. What are my options? That's the options the person will give you. Biweekly, accelerated. Some people think that biweekly and biweekly accelerated is the same. No, it's not. It's not the same. If you just pay biweekly, and you just divide your annual payments by 12, there's no savings at all. It has to be biweekly accelerated. Okay. The second option that the banker will give you, you can do additional payment. That's really the case, you can. The third option, increase the payment. My option that I tell the client, if they're asking me what's the fastest way to pay off the mortgage, I'm not saying biweekly accelerate, I'm not saying do additional payments somewhere, I'm not saying increase your payment. All those options are working, but it's not easy. You have to get money somewhere, right? If you increase your payment, now you pay more for the mortgage. If you do lump sum, 10,000, where you get the 10,000 from? So my recommendation is not just a little bit, whatever you can get somewhere to do as a prepayment. Everything, every paycheck you get should go straight in the mortgage. Your child tax income, straight in the mortgage. If your husband or partner or wife, whoever works, straight in the mortgage. If you get bonuses, tax return, straight in the mortgage without getting, it should not be on your checking account and then you make a decision where it's supposed to go. No, it's supposed to go straight in the mortgage. That's the fastest way to pay off the mortgage. If all your money you make, everything you make, goes straight in the mortgage, because that's when you save money. Because the calculation in your mortgage is done on daily, with this product, traditional mortgage, on monthly basis. The option that I'm talking about, calculation is done daily. And let's talk about this. Now we're talking about all-in-one option. All-in-one option means if you switch to this one, you will not have a checking account where your money is sitting dead. You will not have saving account where the money works for a little bit, but because of inflation, you still will have probably minus 5% on your checking account. You will not have your saving account or checking account. You will not have your mortgage, okay? And you will not have your HELOC if you have a HELOC. Some people have a home equity line of credit. So in this particular case, you will not have those 3 different accounts or 4 different accounts. You will have one account. Your paycheck comes in, your expenses come out from the same account. That's the beauty of the all-in-one, okay? So to understand this, you need to understand that with all-in-one product, you will not have checking, saving, mortgage, and home equity line of credit. You will have one account. Your employer will pay money right into this account, okay? If you get checks or whatever, you take a picture, it's right in your mortgage and it works for you exactly in this moment. Even if the money was there maybe for 2 weeks, 3 weeks, 5 days, 7 days, until you start to use it again because you have to buy groceries, you have to pay credit card. But your paycheck maybe was $2,000, you're not pulling out $2,000 right away, right? You're just paying whatever needs to be paid and the remaining amount is still there. And this is the beauty of this product, that you don't need to be thinking or deciding how much money I can do additional this month, can I do additional at all? Every money comes in, works for you, but you have access to it anytime. So that's the beauty of this product, that whatever you paid off is available for you. Your checking account will show, let's say you have a $500,000 mortgage and you paid off $40,000. Your checking account will show you have available limit of $40,000. The beauty again is you're not just paying off your mortgage fast, you're also creating a cushion. If there is a problem or you need to borrow money, you don't need to go to the bank, you just reuse your funds. The beauty of this product, you get residential mortgage rates. So if you need funds and you don't have access to the funds, what you use a credit card or you go and get a loan. Here you can just re-borrow it back and you're using it with the mortgage rates, which are a lot lower than other rates. If you pay off your mortgage one day, and I hope it will happen with our help soon, and now there's nothing to pay off, your paycheck comes in, everything is paid out already. Okay, in this particular case, now your account shows positive balance, and because it's now positive balance, you get interest rate from the bank. It's your checking account. There's no difference. You will have a debit card, credit cards if you want. You can use your credit cards. You don't have to switch to this bank with credit card. But debit card, whatever. So if you don't have a mortgage, there's nothing to pay it off. Your paycheck still comes in. It will just show a positive balance, and the bank will pay you at this moment 2%. So some saving accounts don't even pay 2%, but this particular bank pays you 2% instead of 0.001 with RBC or other banks. This is also a great product for clients who have fluctuation in income, because self-employed people, they're making good money and maybe they could allocate $5,000 as additional payment to the mortgage, but they're concerned, now I gave it to the mortgage and now for whatever reason my business will not do well, like we had a situation with COVID, now I cannot reborrow. With this option you can. So that means whatever you make as a self-employed, everything is now there, works for you, generates savings on interest rate like crazy. But whenever you need the money, you probably will not need the full amount. You're just pulling it out. And this is a very important point. This is what some people getting confused. They're saying, does it mean that I always live in debt if I buy a washing machine or whatever? No, you're not. The point is that if you understand the model, you're doing today the same. You have your mortgage and then you have your checking account. Let's say your checking account has $5,000. Your washing machine needs to be fixed or it is broken. You need to buy another one. You just take from the $5,000, let's say $2,000, and you bought a new washing machine. The problem is, if we're talking about all-in-one, those $5,000 are not sitting on checking account with RBC and doing nothing. They're in your mortgage and saving you an interest rate. Now you need to buy a dryer. Yes, you will pull the money out from your account. That's really the case. and now your debt will go up by $2,000. But it's not that you're borrowing the money. It's just that the $5,000 which were sitting in your checking account and doing absolutely nothing were working for you, and now you remove $2,000 and they stopped working for you. So this is the one area where I need to make sure that people understand, because I had many situations where the client were confused because they saw they always live in debt. You live in debt today, my friend. It's just with this situation, all your money works for you until you need it and you can take it back. Okay. So now I would like to show you, I just showed you before, you do $10,000 prepayment. The question is where you get the money from. And if you get it, it's nice. I did a 10,000 prepayment, 10,000 prepayment. I saved 32,000. Sounds good, beautiful. But I have $10,000 to pay off. Where am I supposed to get the money from? First of all, where I get the money from. Secondly, if now I got it, how I repay it, right? Let's say you could even use credit card. I don't recommend for this product to use credit card, but theoretically, if you use credit card, it still would work, because the credit card interest rate is a lot less than $32,000 that you save in a mortgage. But let's just go again back to the situation of all-in-one. Now your all-in-one account has your mortgage and has available limit. Let's say, and we usually, if we do this product, let's say a client needs $300,000 mortgage, we usually give them $50,000, $100,000, depend on equity in the house. We give them available limit, let's say, $40,000. Now the client borrows from the available limit, pays the mortgage down, saves $32,000, but he has to repay the money. And I on purpose use a crazy high rate here, okay? You borrowed a rate of 6.45%. So you borrowed from, let's say, your available funds, and you're paying 6.45% interest rate, okay? Here's the beauty. The product that I do, you will not pay 6.45. You will pay about 3%. But this is a secret. This is my secret. I'm not just going to share it with you. This is only for my clients. So you can assume if you borrow money to do something, in my case, let's say to do prepayment, you will pay only 3% interest rate, even if you're supposed to pay 6.4%. Okay, I'm not going to go into details because this is a secret. We'll share only with our client. Let's say if you need one entire year to pay off those $10,000, it would cost you $570 an interest rate. Okay, $570 it will cost you to have the $10,000 borrowed and repaid, compared to $32,000 savings. If it takes you 2 years, okay, if it takes you 2 years to pay it off, not just 1 year, let's say you are not able to pay it off the $10,000 within a year, it will cost you $675 in total for 2 years. Guys, this is the point that you need to understand. You borrow money for $10K, you prepay your mortgage, you save $32,000, and it costed you only $675 if you're able to repay the $10,000 within 2 years. And the question is, how can I repay the $10,000? Some people maybe will never repay it. And this is the beauty of the all-in-one product. You don't need to be worried about that. It's happened automatically. You borrowed from your available funds, your income comes in, it pays off automatically your balance. So the majority of my clients, with the structure, how I do it different than the banks do. How I structure the deal, you can assume that whatever you borrowed for the prepayment, you will pay off in 6 months. Okay? But you're saving a lot of money. And here, this is something which is fact miss, because lots of people saying, oh, I heard about this product all-in-one. The rates are crazy expensive. This is not the case. With my product, with my VS all-in-one, I can promise you that the majority of your mortgage will be with the same interest rate, whatever the rates are in the market, maybe 0.1, 0.2 difference, but with the same interest rate that you have in the market, if it's 5-year fixed rate, for example. And the small portion, or another portion, which is for the higher interest rate, will have even lower interest rate than the sub-account. We call it main and sub-account. I don't want to go in details, too complicated. This is, you will figure out whenever you call us, we'll explain you everything else. For me, it's just important that you understand that with this product, if somebody tells you it's expensive, it's a high rate, it's not the case. I on purpose showed you before, with higher rate, you still will be ahead. But the beauty is, with my program, which how I designed it, with VS all-in-one, your interest rate will not be higher, will be the same. And you're paying off your mortgage faster. So it cannot get better, right? So this is why this is important to me to show that if somebody tells you it's expensive, it's not. And even if it would be expensive, you still will be ahead. But the beauty is, with VS all-in-one, with the product that I designed more or less, you will not pay more interest rate. You will pay the same interest rate, but you will have a lot shorter amortization, because now all your money works in your mortgage. And the interest rate calculation is on daily basis. So if the money was there only for 5 days, you saved interest rate for 5 days. Okay? And you will see it on your mobile application. There's a nice graph that you can see how your mortgage goes down. It actually helps you to have full control, because if you have traditional mortgage, you get your statement once a year, you look at it, you start crying because not much change, principal, interest rate, pretty much nothing. Or people who have variable rate with fixed payment is even worse. They look at their statement, they actually didn't pay anything off because everything went to the interest rate. So the beauty of this product is every dollar you make works for you and pays off your mortgage. And usually majority of my clients are targeting 10 years, maybe 12 years, but some of my clients paid off even the mortgage in 3 years. Here's now something important I would like to mention. This option, the banks hate this option. If you deal with TD, RBC, or Scotia and you come to us and we will do a mortgage for you, okay, they lost just the mortgage business, right? And they will try maybe to get it 5 years later back. If you come to us and we give you all in one, because we do all mortgages, we like traditional mortgages. They're a lot more profitable. Traditional mortgage lenders paying us a lot more money than the all-in-one lender. But I always say you need to sell what you believe in it, what you use. I use this, my brokers are using this product, and we like to sell it. And yes, we'd still make good money because we do high volume. And I'm actually number one in Canada by selling all-in-one product. I'm really proud of that. But you need to understand that the banks hate this product. Why? Because they're not just losing the mortgage, they're losing everything. Because you're moving your checking account, you're moving your saving account, and they will lose you completely. I mean, you can still have your RSP and tax-free saving there, but the majority of your day-to-day banking is going to leave them. That's why they're going to fight and trying to prevent that you leave them. And what they can do, just a bad mouse, because they cannot argue with my numbers. I just showed you, but I will tell you which questions you should ask your lender, and then you will know that I'm right. Okay, please write this down. That's the question you need to ask the banker if you go to your bank, because I always say you can go to your bank and ask questions, but if you go to your bank and ask questions, just ask them if they say, because some of it, I had situation where there's 3 answers you can get. First of all, if the client has no idea what he's talking about or what this product is about, he will just give you answers that will not make any sense. But let's say you have a person who knows this product or hear about this product, okay? He will say, we can do something like this with us as well. You don't need to leave, you can do the same. You can pay your paycheck in, just open a home equity line of credit, and then when you can borrow from there, prepay, and then you can move money back and forth. I always say, ask them 3 questions. First of all, if you have this product, give me a calculator, because I want to have a calculator, not just type in biweekly payments, lump sum payment, or whatever, increase the payment. I would like to have a calculator where I type in my income, my daily expenses or monthly expenses, childcare, and maybe, my mortgages, my insurances, my credit card bills. I would like to type in everything I make as income, let's say my income, my wife's income, and child income, whatever. And then I would like to type in all my expenses, including gym membership, and I would like to know how much I will save. They don't have it. They don't have this option. You can only change to lump sum, bi-weekly, increase the payment, but you don't have an option which is 100% customized to you. In our case, we will give you a report where we will show you based on your questions, answers to our questions, we will show you how much you will save by switching from traditional to this one. And you will need to fill out a form, because we want to make sure you're not missing anything. Because if you talk to a client, how much money do you make? 6,000 a month. Great. How much expenses? 3,000. No. Let's go a little bit deeper. We'll give you a list, please complete. And then there will be everything: telephone, internet, credit card, food, gym membership, this and that. Then we have a real number, and we run a report with those numbers, and we're showing the client how much he will save by switching to this product. So number 1, you need to ask your lender a calculator. They should give you a calculator where you can type in your income and expenses. Second one, I always say, ask them for a statement. If they have products like this, maybe they should show you a statement from a client. They should black out the name and everything else. You want to see how the mortgage amount goes down. They don't have it. They cannot provide it to you. And the last one is the best. If they have something similar, okay, ask them if you can deposit your income from your employer straight into the mortgage. They will tell you no, it's impossible. The income has to go to the checking account, and then you will make a decision how much money goes there, how much money goes there. So that's the big difference between all-in-one product and the banks. If you try to do something similar, that you cannot deposit your income straight in the mortgage, because at this moment, whenever your money comes in and your checking account with all-in-one, you save interest rate from the same day. With those guys, you have to deposit in the checking account, make a decision how much money you will prepay, but then maybe you need the money back and you cannot take it out because it's traditional mortgage. So it's not even comparable. Okay, it's not even comparable. But sometimes, if I feel a client is a little bit struggling to understand, I always say to him, if you really think you can do it on your own, do me a favor, try it for 3 months. Try to, whenever you get paycheck, move the money into your mortgage, and then, I mean, you don't have the option to take it out again. That's the problem, right? But next month again. The problem is that you will not do it every month. You have to be organized, and the other problem, you cannot pull it out, okay? There's one commercial that the bank I like to do business with, Manulife, because there's 2 lenders who offer all-in-one product, okay? I like Manulife because they're treating me well. I'm number 1 with them, and I was able to figure out a way. It's a lot better than the bank is offering. But doesn't matter. This is not the point. So they had a commercial recently running. I love the commercial. This is like a 1 minute commercial, but it's a bang on situation. And I would like to show you the commercial. I'm pretty sure you're going to enjoy it, because this is just bang on. Within a minute, you will understand why it doesn't work with traditional lenders and why this will work with this one.
Hello?
Do you like games, Trevor?
Who are you?
This is how the system works, Trevor. It's a game called Manage Your Money. And all you have to do is keep things spinning. This is your mortgage. You must keep it spinning at all times. This is your checking account. This is your savings account. And your line of credit. Your checking account's running out. Better transfer from savings. Now you're not earning any interest. Look out, Trevor, your line of credit is wobbly. Remember, keep that mortgage spinning every 2 weeks.
This is hard.
Why is it hard, Trevor?
There's too many parts.
And?
This isn't fair. The game was designed
to make you fail? Would you like to see a mortgage done differently? This is Manulife One. Your mortgage, savings, line of credit, and checking combined in a single account. When you deposit income, you automatically pay down debt, which means you're instantly paying less interest. When you need money, you draw from the same account. And so simple to manage. You could save thousands of dollars by doing less.
You know, I really like this commercial, because it shows you that really, if you try to do it on your own, it's not gonna work. And you know what, guys, if you think it will work, let's say you're under the impression that this guy just doesn't know how to turn those wheels, right? I can give you the opportunity to do it. It's actually right here. The box you saw in this video, it's right here, you know, and all those wheels are right here. So if you want, just let me know, give me your address, I will send it to you, and you can experiment, and then you will know if you can do it or not, okay? So the answer is, for sure, you will not be able to do that, because really, there's only, I would say, less than 1% of people maybe will be so well organized that they will do those daily transactions. Money came in right away there, and then for whatever reason you need to pull it out. You know, you have to somehow pull it out. So why redesign the wheel if this can be, it's already done, and you don't need to do anything. You don't need to be worried about anything. You don't need to guess how much money you can prepay by end of the month. It's whatever left over by end of the month is automatically prepaid your mortgage. And whatever came in and left the account, still during the time that it was sitting on your account, because it was sitting in a mortgage, and the interest rate calculation is on daily basis, you saved already 5 days, 10 days, and so on. It's a crazy powerful product. And yeah, let's now continue, because I would like to continue with the presentation. You know, whenever I do seminars, I always like people to ask this question: why do you think that so many people buying with Amazon? You know, there's many different options, and I get different answers. You know, it's cheaper and this and that, but the real reason, it's convenient. because of convenience, I'm willing to spend more money sometimes because I don't want to go to the store and see what's on sale. It's the same with the mortgages. If you have to do lots of stuff every month, lots of movements, you will give up. The beauty of the all-in-one product, you don't need to because it's done automatically. Okay. I just want to show a couple additional benefits that you will have by using this product. First of all, if there is a recession or we have a financial problems, right? What do people do? They're trying to take money out of the tax-free saving account, RRSP. With this particular product, because you pay off your mortgage so fast, you have available limit. So you can actually pull out money from your bank, from your available limit, and not pay any taxes because, again, you have access to it. The other one, as COVID-19 hit, many people called the bank and asked for deferring a payment, right? Because they couldn't do the payments, they lost a job or whatever. With this product, you don't have to. You will just not pay, okay? Because you have available limit. So none of my all-in-one clients call the bank and ask for deferring a payment because this is automatically included in your system. If you don't have money, if nothing comes in, you just live from available funds. Because the bank didn't forgive you the mortgage payment as you call them in and ask for 6 months deferral, you defer the payment. So that means now whatever you didn't pay will be on top of your mortgage, and now you pay interest on top of the interest and plus compounding. It's going to be very expensive, okay? So whatever you paid off with this particular product will be available for you. For whatever reason, you can do whatever you want. And here's the other one, which is very important. If there will be problems in life, and there could be, right? You lost a job, some financial problems, bankruptcies. There could be a situation nobody will give you ever a mortgage. The beauty of this product, even if you paid off your mortgage, let's say you had a $500,000 mortgage, you paid it off, now you have $500,000 available for whatever you want. You can do whatever you want with it. Why? Because nobody will requalify you and double check if you still work and so on. And in most cases, if people are in financial trouble and they go to the bank declined them. Why? Because they realize the guy lost a job. With this product, you don't need to go to the bank because now your own bank, you borrow just the money whenever you need it. And the best part is, whatever you borrowed, you will pay it back fast. Why? Because all your income will go and try to pay off whatever you just maybe reborrowed because of your financial difficulties. I also like to say that this product is perfectly designed for self-employed people, but also for older people. I always say that this is the mortgage option that every person before they get retired should get. First of all, you pay off the mortgage faster, so before even retirement, you should be debt-free. The second advantage is if you retired, your income is so low, nobody's going to give you money, right? But just because I'm retired doesn't mean I don't want to spend money, right? Maybe I will help my grandkids, graduation or wedding, or there could be many reasons why I would like to borrow the funds. And in this case, you don't need to go to the bank and ask for it. It's available. And again, you borrow the funds, let's say pay for your grandchild education, because income, everything, whatever comes in, pays off fast, and then you get rid of it. So it's a perfect product for people who are getting older or close to the retirement. I know there is a reverse mortgage, but it's not even comparable. Because reverse mortgage, you're getting in debt, and really, your kids will just get less money whenever you die. With this product, you can borrow and repay it quickly because of the all-in-one concept. I'm just trying to see if it's anything I forgot. No, I think I covered everything. This is one slide I would like to show you, which I also like to show in a seminar, because I also ask people, look, here is an example of a calculation, okay? The all-in-one calculator. The person paid off the mortgage in 16 years and 11 months. But the savings and interest rate, only $2,395. Guys, believe me, I had challenged to manipulate the calculator so bad that I could come up with this number, because the Manulife One number, it's the interest rate that you save during the term of your mortgage. And for me to show it, you save only $2,395 was very, very difficult. So I literally manipulated numbers to make the numbers bad for this particular reason. So, question to you guys, would you do it? You paid off your mortgage in 16 years and 11 months, but you saved only $2,395. Would you go through the hassle, changing your account, inform your employer, Revenue Canada, this is my new account, and so on? You probably will say no. For $2,395, I wouldn't. But for someone who looks a little bit behind the scenes, would realize, and I'm always proud of people who are sitting in my room if I do seminars. There are people saying, yeah, but I paid off the mortgage in 16 years and 11 months. There's now like 8 years time without any mortgage. You know what it means now? You don't have a mortgage, like I said to you before. The air smells different. The grass you walk on feels different because you don't have a mortgage, right? But now you have 8 years time without a mortgage. Now do the math. Use your monthly payment, let's say $2,500, times 12, because it's 12 months, and times 8 years. You will get a crazy high number. And if you use those available funds, because now you don't need to pay the mortgage and you will use it for investment or whatever, you can save a lot of money. And now I want to use another gentleman that probably all of you know, Warren Buffett. He said that if you will not figure out a way that money will work for you during the time you're sleeping, you will work until you die. And that's exactly what I'm talking about right now. If you have funds now available because you paid off your mortgage and now it's $2,500 available every month, use it for the investment because you will need it in retirement. And just give you an example, okay? In this particular case, let's say the monthly payment for $2,668. It's actually the payments for the mortgage I just showed you previously. And now you don't need to pay it anymore, right? Because you're debt free. And let's say you have 10 years time now. So 5% interest rate. I'm not going crazy. 5% average interest rate that you could make because now you're investing those $2,668, and you will save it for 10 years. You will save $320,000 in the next 10 years because you don't have a mortgage payments and you use the mortgage payments now to save and do a savings with 5% interest rate. And because of compound interest, it's actually $408,000. That's how much money you will save if you pay off your mortgage 10 years faster. In the next 10 years, you would use those payments not to live better. You could also, but if you use those payments to do investments, you could actually, by end of your amortization of 25 or 30 years, you could have not just paying off your mortgage, you paid off the mortgage, but you also saved $408,000. This is just an example I want to show because those are crazy powerful numbers, okay? And the problem is that many people work really hard. I have so many clients, they work day and night, they work overtime, and they have already a problem with the family because he works day and night, but they cannot get around. And the reason why, because they're good at making money there, but really bad to keep it. It could be money mismanagement, it could be because you allow the bank to take advantage of you. And that's what I'm proud of, that if my clients do business with us, with my team, we try to make this deal, even the mortgage or insurance, doesn't matter, that the banks will have not really tons of advantages and they take less from our clients because we don't work for the bank. We represent the client. Nobody can fire me, for whatever I say. That's why I can talk openly and really promote or set up mortgages the way that I like, what saves the client money and not really number one priority for the banks. Now, who is the right clients for this product? Really, any person who is responsible with money. I like to ask question, do you pay your credit cards to zero every month? Yes, I do. Great. You're the right person for this bank because you have to be careful. You pay off your mortgage so fast, and if you cannot control your spending behavior, you can reborrow it for, snowmobile or boat or some kind of unnecessary stuff. But because you see every day what your balance of the mortgage is, and you like to see this graph goes down, I actually realized that 99% of my clients are getting more conservative with their spendings. I always say you don't need to eat less or travel less, just have the same lifestyle. And because of the model, you pay off your mortgage a lot faster. What I realized that my clients are actually eating less and traveling less and spending less money on dress. I'm kidding. But really, because they like to see, they're motivated. Every day you see how your mortgage goes down, and with traditional mortgages, you get your statement once a year, and there's not much motivation because it dropped from here to here, and everything else was interest rate. So, for every person who has at least $100 left over after he paid all this expensive, makes sense to go to all-in-one. If you're responsible, pay off your credit card, and even let's say you're maxed out with credit card, we're just helping you out, but we want to make sure that your future financial behavior will be properly. If you have high expensive debts, like credit card or car loans, if we do the all-in-one, we're paying off everything because we don't want to have any other payments than just one mortgage payment, and all your income now is concentrated to pay off this mortgage and not pay off car loans or credit card or anything else. It's very, very profitable for people self-employed. I mentioned, right, self-employed because their income is fluctuating. If they have more money, they could do prepayment. Then they're concerned maybe they need money down the road. With this product, you don't need to be worried. Whatever you make is working for you and pays off your mortgage faster. You save an interest rate. And if you need the money, reborrow, you just get it back and it stops working for you. Not that you're borrowing back money. No, the money just stops working for you. Okay. Very important. This is a very important topic, guys. Many clients come to us and they like this product. They're pumped. They want to switch right away. and they talk to us, they don't qualify because there's some restrictions to get this mortgage, okay? And we force the client maybe to place with a traditional lender for 2 years, 3 years, 5 years. We always place mortgage with the lender with the low penalty, always, okay? Because for us, it's important that whenever the client is ready to switch to this product, we can take him out with a low penalty. It's impossible to do it with traditional banks, RBC, TD, Scotia, Bank of Montreal. If you did a 5-year mortgage with them, you're stuck. The penalty is unbelievably expensive. I probably will quickly run through the penalty structure, how it works, but I don't want to make this video too long. It's already long already. But I want to make sure you understand that if you get a mortgage with traditional banks, and if I get a phone call from a client and he's RBC, TD, Scotia, and I heard about this all-in-one product, I want to switch, the first thing I ask, who's your bank? RBC, TD, Scotia. How many years left? 3 years. You know what? You're stuck with this bank for now. The penalty is very expensive to get out. Let's wait until your mortgage is due for renewal, and then I will move you. But if your mortgage is with one of our banks, the penalty is really low, lower, not low, but lower, a lot lower, sometimes 4 times lower than the traditional banking. And for us, that's why we control this. And if we know the client is ready to go, we will pull your mortgage and move it to all-in-one with a little bit loss. Yes, there will be a penalty. If you had a 5-year term and we do it after 5 years, there's no penalty. But let's say you have a 5-year term and we move you to a new lender in year 2, yes, there will be a penalty. And we had many clients who even were with the banks, RBC, TD, and Scotia, and they liked this product. They understood the product, special, accountants and economists. They understand the product right away. They say, no, I don't want to wait. And then we explain them, look, if you break the mortgage, you're going to pay big penalty. Doesn't matter. I did my math. It still makes sense for me to move now. We can do it as well. This will be a discussion on an individual basis. So I just would like to show you how the penalty structure works with banks, and we call it monoline banks, the lenders with the low penalty. It's actually the same banks, to be honest. They get the money from RBC, TD, or Scotia. It's just that they're doing mortgages only, and to do mortgages only, they have to be better. Why would you go to a monoline lender if he has the same mortgage rate, same conditions, terms and conditions than traditional bank? You will just do it with traditional. So the monolines have to really be good with something to be able to attract bank's client. So and then what they're attracting it with? Interest rate for sure, but the second one is the penalty structure, because 65% of mortgages don't make it to year 5. That means all those guys paying penalty, and sometimes bank make more money with the penalty than they make with the interest rate. Okay, so I just want to show you an example. It's a $400,000 mortgage with the monoline and with the bank. Interest rate 4.9 here, 4.49 here. So the same interest rate. Okay, for me it's important. I show everything the same. Let's say in year 2 the client decides to break the mortgage, and it's still 3 years left. Okay, what the bank will do, they will look at the 3-year rate. I'm trying to make it as easy as possible. It's a lot more complicated, the math, but I'm trying to, for the purpose of this presentation, make this as easy as possible to understand how the penalty structure works. So you got a mortgage for 4.49. You're breaking the mortgage, and the market, the interest rate in the market is 3.5. And keep in mind, guys, because the rates right now are very high, and we expect the rates down the road to drop, penalty will be a big topic, because this is the difference between the rate that you had and between the rate in the market during the time of breaking the mortgage. And as we had a low rate environment and the rate went up, the penalty structure actually was favorable for the client. It was smaller. Now the interest rate is up, and if the rates will go down and you break the mortgage, now the bank says, look, guy, we gave you 5.5 rate, and you're breaking it year 2. If we give you your money now somebody else for 3%, we really lost 2.5%. So we want a compensation. That's how the math works. Okay. Now, here's the big difference. The bank says, okay, the penalty is the difference between the rate that we gave you and the rate today in the market. In this particular case, 4.49 to 3.5. Look at the banks. The banks are saying, no. We gave you 4.49% because you're a good client. We gave you a discount. But really, our posted rate during this time was 6.14. Okay. Now look how the math works. In this particular case, posted rate discount, monoline doesn't exist because they don't have posted rates. All our big banks have posted rate. Now there's a difference of 1.65%. Additional of the difference between the rate you got and the rate is today in the market, there is now with those banks additional 1.65%. And let's do the math now. Now you need to realize how much it will make the difference in money. With the monoline lenders, we will do 4.49%, the rate that you got, minus 3.5%, which is today in the market, The difference is 0.99. The bank says, look, we're losing because you're breaking the mortgage, 0.99%. We want this money. Okay? The banks are saying the same, 4.49 minus 3.5, but we gave you a discount of 1.65%. Because you're breaking the mortgage, we're adding now the discount to the penalty interest rate. So now it's suddenly 2.64% interest rate and not 0.9. It's a big difference. And now guys, look at numbers. 400,000 times 0.99%, it's an annual loss for the bank, $3,960. That's how much money will lose the bank because you're breaking the mortgage and they have to give it somebody else for a lower rate. With banks, 400,000 times 2.64%, because it's not just the rate difference, it's also the discount they gave in the beginning. So now it's 10,560. Look at the difference per year. And you have 3 years left. So that means we have to multiply this by 3. 11,000, 3,900 times 3, 11,000. And now we do this amount, 10,500 times 3, 31,000. Do you see the difference? It's a huge difference between the banks and monolines. And I'm proud of that 99% of the mortgages we do with my team, I have 10 guys working for me, we're doing it with low penalty lenders. Why? Because we know that something can happen in the family, divorce, health issues, you will be breaking the mortgage, you will pay high penalty. Or in the situation of the client wants to switch to all-in-one or just switch to a better interest rate, that's what we do all the time. With monolines you can, with banks you cannot, because it's just way, way, way expensive. And that's pretty much the last slide I would like to go through. This is why you should do business with us, okay? I mean, you definitely can say, you can say whatever you want, but facts are the facts, right? So I'm #1 mortgage broker who offers all-in-one product in Canada. Not in my province, in Canada. So, and this option is available only to a certain amount of mortgage brokers. The bank is not doing this type of product with everyone, because this is something which you need to explain, and many mortgage brokers don't get it. They don't understand how it works. That's why they don't want to sell it. And second reason why many brokers don't want to sell it, because it's less commission. It's not so profitable, okay? The second difference between us and the other mortgage brokers or options that you can get this product from, that we have full control about your mortgage. We're setting it up the way how I want, not how the bank wants it or how the financial advisors are offering it, okay? I will set up the mortgage the way how I can see it, and this will work a lot better than, it will work with traditional all-in-one as well, but with it's like a lot faster than with the traditional all-in-one. We will set up the main and sub account. Don't want to go in details, don't want to confuse you. All this stuff we will discuss with you. And the other part is also, if you switch to this mortgage, maybe you will still have some questions. We're available. I have 10 guys sitting in my office. You can call them, they will answer the questions, they will help you, because we have a great relationship with this particular bank. And if there is some problems and you cannot figure it out, we can figure it out and solve it on your behalf. And VS Solutions, that's my company name, we're also all-in-one. We do mortgages, we do insurances, we do house insurances, we do investments. So you can get everything from one place. And if something happens, you always call the same number. So I think there is an advantage to go this route. And I hope that you like the presentation. I'll be very happy if you will share this maybe with your friends and relatives. I'm pretty sure that you know someone who would like to be mortgage free sooner. And I really think that this is nothing better. This is a revolutionary product, and I hope you understood. And again, if you have additional questions, give us a call. All my information is available and will be available right on the bottom of the screen that you show on the PowerPoint. That's pretty much everything for today. Let us help you to save an interest rate. And my goal is that you will be saving as much as possible on the rate. And VS All-in-One is the best option. That's it for today. I wish you all the best. And I guess until the next time in the virtual world. See you later.